Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
To another edition of Premium Cashflow Podcast. Today, I'm joined by John Cohen from Toro Real Estate Partners. Welcome to the show, John. I appreciate your time today.
Oh, no, I appreciate it. Thank you for having me on. Hopefully I can get some good value and some good conversation for all the listeners.
Absolutely. For folks who don't know, John is completely a heavy hitter. He is as dynamic as you can get. Their group currently controls close to $300 million worth of real estate, just about 4,000 doors. And the amazing cool thing is that they have gone full cycle on several deals, meaning they have bought, they have done their business plan, and also sold those properties for lucrative gains as well. So we will kind of dig into their story. Their group operates a lot of properties into C-class, which is, perhaps maybe 60s, 70s built properties. So there are interesting nuances when you start dealing with those properties. So we will kind of talk about some of those aspects as well. So to help us get started, John, as far as, how you got started and how you kind of came into multifamily.
Yeah, so I started actually in the finance world. So I had no real estate background. I was, I graduated college and I played baseball in college. I'm not a good student, you could say. That's the nice way to put it. And when I graduated from school, it was, get a job or figure it out, right? So I got a job and, it was a regular, stockbroker, which I parlayed that up to, actually getting a job at Morgan Stanley in the financial advisor program. And I went through a 9-month interview process at Morgan Stanley after working for 2.5, 3 years. I got hired after 9 months of interviews and back and forth and meeting with this person and that person. And I got hired. And my first day at work at Morgan Stanley was when Facebook IPO'd. I walked into the office and quit the exact same day.
Oh.
So I called my mom on the drive home and I said, she's like, what are you doing? You should be at work. I said, I quit. And she was like, what are you doing? Like, why would you go through all that headache and everything you've done and why? And I basically said, I hate it. I don't want to do it anymore. And I just didn't enjoy what I was doing on a daily basis. And I just saw when Facebook IPO'd, it didn't do well. And Morgan Stanley was, they brought it to market. They brought it public. So I just saw people's face like, oh, like, what are we going to do? Right. Now, prior to that, while I was doing that, I had been buying some properties here, buying some properties there, and messing around with some real estate stuff. But I had a passion for that, and I was reading a ton of books, and I was a lot of podcasts, or not podcasts at that time, a lot of webinars, and just watching a ton of stuff. And I said, you know what? I can get into this. Like, I'm good at raising money. I had a decent book. Why don't I just parlay that into real estate and go find some real estate deals? And that was the vision. And at that point in time, all this crowdfunding and syndication, it was being done, but you couldn't just generally solicit. There was a lot of rules against it and blue sky laws and security filings. So right out of the box, my dreams were like shattered. It's like, all right, well, you can't do that. You got to figure out a different way. So I ended up just getting my real estate license and doing rentals and sales in Manhattan. So I sold some property. I rented some property. Then I turned that into, I wanted to be a commercial broker. When I remember the interview, I interviewed with all the big shops, and the first interview I went on happened to be on my uncle's friend, and he said, why do you want to do commercial real estate? And my answer was, I want to sell big buildings and make a lot of money. I mean, why else do you want to do this? I've already sold the apartments and I've rented the apartments, and he said, you got to do a little bit more research. I don't think you really know what you're talking about yet. So I went home and I was like, oh, wow, you can do industrial and office leasing and multifamily sales. And there was so many different product classes. So after all the interviews and educating myself a little bit more, I ended up doing multifamily investment sales for Marcus Millichap.
Interesting.
And that's when I fell in love with multifamily, just going through the Marcus Millichap training program, hearing what people were doing in the office, interviewing my clients when I would go show buildings or when I would go meet an owner, and just I fell in love with a guy that bought a property and 20 years later it was worth significantly more money or whatever it is. So I said, okay, I need to do this. And then that's when I basically, started educating myself on the multifamily side. And really in 2013, 2014 is when I quit Marcus Millichap full time. And I basically said, I'm going to make this my business. And I went 100% into that's when the real focus on the multifamily stuff came together. And that was when, that was the start of it all. It was in 2014 after working at Marcus Millichap, basically saying, let's make this a full-time business and not something part-time, which it was from 2009 to 2014. It was just buy a property here, go to a tax auction. It wasn't a business yet. And then in 2014, after going through Marcus Millichap's training program, I said, this is what I want to do.
And as you started then in multifamily there, John, were you all savvy about, sort of all the lingo, all the other stuff as far as, hey, which markets to buy and all that? Was that all that professional enough or that kind of developed afterward?
That developed after. They gave you a really good foundation, but then the drivers, the lingo, yes, I knew that, right? What a cap rate was, NOI, rent roll, all that stuff you get. Right. But understanding markets and submarkets, they teach you at a very, very, very high level. And then you pick it up as you go, right? You start touring deals and it's like anything else. And you learn it as you go and you really become an expert over time. Sure.
Now, as you start, purchasing the assets and things like that, you go in a submarket and stuff, right? Let's say, assume you are new and you enter, let's say a new market, you're kind of driving down the road and you're coming up to the asset and things like that, right? How do you evaluate all of that data? What takes you, or how do you understand that submarket? Could you maybe kind of give your philosophy around on the road understanding all that movement that goes on and then transforming into, okay, this asset makes sense?
Yeah. So I think, we have a quick 30-second that anytime we're looking at a new market, the technology today is phenomenal, right? You can go on Google Maps and go to the Google Street View and you could basically walk an entire neighborhood before you even leave your house.
Sure.
And how you look at a market, there's A locations, B locations, C locations, and D locations. And there's A property, B property, C property, and D property.
Sure.
The easiest way to do it without, judging anything is just looking at everything around, right? When you're looking at a property and you're driving down the block, go on Zillow, go on Redfin, and look up the values of the houses, right? If the houses are $1 million houses, you're probably not in a D location. And if the houses are $30,000 houses, you may or may not be in a rougher location. But then it extrapolates, right? So you have that immediacy. When you're driving down, what do you see, right? Everybody has a feeling inside. And nobody, I don't think people weigh it as heavily as maybe it should be. But when you're driving down a neighborhood, is this an area where you wouldn't mind going for a jog on a Sunday afternoon? Or is this an area where you're always looking over your back? And that goes to the retail, right? What's the retail in the location? When you're driving up and down the block, do you see Starbucks and do you see Whole Foods and do you see, major retails that spend millions and probably billions of dollars on demographic studies? What's there? Is it Starbucks and Whole Foods, or is it a check cashing place and, a liquor store, right? That is all the stuff that you put into your analysis, and you say, okay, I was driving down this block and there's a Starbucks, there's a Whole Foods, there's a brand new Chase, and all this retail there. And I went on Zillow and I saw $200,000, $300,000, $400,000 houses. And that's how you give it a rating. And that rating is subjective, right? There's criteria that an A rating is X and a D rating is Y, but you got to put your own spin on it, right? It's what you feel comfortable with going to bed at night. And that's how we look for opportunities. We basically say, okay, what type of locations are this? Good, bad, or indifferent. And then we try and find the opportunities in that submarket where maybe the rents are low or where the property's really beat up. And that's how we identify opportunities. And then after all of that's done, the two biggest things that you have to check, you got to check the school district and you got to check the crime report. And you want to know what type of crime's going on. And you want to know, as a school district, good, bad, or indifferent. And those are all that's how we overview a market and make a decision. And that stuff, that can be done in 15, 20 minutes. by walking up and down the Google Street, looking at Zillow, checking out the school reports and stuff like that. And that's what I recommend anyone do, before you even underwrite a deal, get comfortable with understanding what an A, B, C, and D location are, because you're going to be able to whittle through deals faster when you see, okay, this is in a D area, I don't want to buy it. And no, this is in an A area, that's not for me because there's no upside. So understanding markets is the biggest thing, and you can whittle down areas that you want to invest in and you don't want to invest in very quickly.
Incredible. Thank you for that detail. Now, John, speaking of the school district that you said, do you think that's a major factor in your opinion when you're looking at stuff? How's your experience like?
So that's a great question, right? I know the single family world, school district dictates everything, right? That's super important. The multifamily space is weird. It's different. The most recent property we bought is in a great school district. And after we closed on that deal, we basically said, school district significantly more important than it was in the past. We buy historically, we've always bought very rough, super heavy lifting deals. More often than not, they're not in the greatest. They're more C-class property than A-class property. Not saying that a C-class area can't have a good school district, but it depends. I always tell people your school district depends on what you're buying. If you're buying a building with all 1 bedrooms, your school district probably is not as important than if you're buying a property that's got mostly 2s and 3 bedrooms, because 2s and 3 bedrooms will yield a family, and most likely a family will go to school. So you want that, you want to understand it. Is it a make or break for us? No, because there's a lot that goes into the evaluation of the deal prior to we get to school district. But after the last deal we bought, we're tweaking our acquisition criteria every 6 to 12 months, and we've moved school districts significantly higher up because, one, with all the Corona stuff and the market and where it's at, you probably want a little bit better located properties, at least we do. And then if you get a good school district and your families that live in your apartment want a place to send their kid and they can't afford the housing in the area, well, your apartment complex will probably do really well. So if I was recommending anyone, it's got to be personal preference, but I would weight school district probably higher than most people talk about, but at the same time, understanding what you're looking to get, what are you looking to get out of the investment? Sure.
Now let's talk about some asset types here and, sort of how that methodology plays into purchasing them, so we are talking, let's say, asset class C, B, and B plus and things like that, right? So for example, now some of the great markets and submarkets that we buy, right? I mean, the prices are definitely going up. There's just so much cap rate compression around, right? And what are your experiences? I know that your group has purchased a lot of C-class properties, right? So, and as we all were discussing earlier, John, that there's just so much of housing and asset stock that's in that C space, like the 60s, 70s, and things like that, right? So what are some of your sort of experiences, perhaps, or you may want to call it consideration that when you're purchasing them, are you shying away from that? Hey, perhaps this is a C-class deal. It probably has, sort of bad electric, plumbing, and things like that we want to check out and stuff like that. So what is your thought process there? Are you kind of very conservative about it, or you will say that, hey, you know what, let's not worry about C-class, let's stick to maybe B plus, whatever, 2000 plus built and things like that, and let's do lesser work in that B plus asset space? Could you maybe share some of your commentary around all?
No, 100%. When we first started, my experience was always in the rougher, heavier lifting stuff. And you learn a lot. That your electrical, your plumbing, your foundation, your roofs.
We are brothers in that regard, by the way.
There you go. Exactly. And you learn a lot, right? You buy a building and next thing you know, you have a plumbing problem. Maybe you didn't pick it up on due diligence, or maybe you didn't think it was as bad as it was. So today I don't shy away from those deals, but anytime we look at those deals, the first 5 questions or 6 questions I ask a broker, a seller, or anyone that brings me a deal, what's the condition of the roof? What type of plumbing? What type of electrical? Foundation, and major deferred items. What's been done? Do we have a schedule on it? Do we know HVACs are in that major deferred? Like, what are the HVACs? What are the condition? Are they all dead, or they need to be replaced? Then the other question, the other motivating factors, why are you, or why is this person selling? What's the motivation behind the sale? Because 1960s and 1970s properties are now coming on, almost 60 years old.
Sure. Mm-hmm.
So 50, 60 years old, materials have changed, right? Cast iron plumbing, polybutylene plumbing, things are different, aluminum wiring, copper wiring,
Sure.
Kohler connections, all those things add up. And if you've never operated a 1960s deal and you go in and you think that your below the line reserves are going to be 250 or 300, like a bank may say, you're going to get caught, you're going to get caught with your pants down. So
Sure.
we don't mind that stuff. And we happen to do that stuff very well because mostly every deal we've owned has been 1960 to 1980, really. Nothing really after 1980s. But that's the stuff that we look for in due diligence. So if we like a deal and we go through it, we scope every line, we walk every roof, we take off the outlets and see what type of wiring it is. And if you're going to go after those deals and you don't have a good understanding of what your CapEx is going to be, you're going to be caught. And there's upside with C-class deals for sure. But you have to understand, like, putting in new wiring is not going to make your rent go up. That's just going to cause you from having a problem. If you have old wiring, your insurance is going to be more expensive. So you got to fix that. If you put a new roof on the building, you may or may not get a rent increase. And when I say may or may not, you can't put a new roof on a building and charge an extra $100. You could put a new roof on a building and rent the unit that had water damage, but those are not dollar items where you could say, I'm going to put granite in and I'm going to get $25. There's no return that you could say, I'm going to put all new roofs on this and I'm going to raise the rents $50. It doesn't work that way in that space. So understanding what that stuff's going to cost is extremely important, because you can go buy a 1990s, a 2000, a 2010 built deal. You can go to bed at night. You're probably not going to have many problems, right? You're going to have there's problems on everything, but those deals have less headaches. And you could, you understand that if it was built 10 years ago, I'm going to have to do roofs in a couple of years. But the 1970s stuff, it's shingles on top of shingles on top of shingles, or it's flat roofs. So you just want to understand that stuff. I don't recommend people not buy 1970s stuff, but you got to understand, if you're in Charleston, South Carolina, and you have a 1960s built deal, there's a lot of trees in South Carolina, and there's a lot of roots in South Carolina. So your pipes are probably, they could be pretty messed up, but you just want to understand the pitfalls of the older buildings. And then you want to make sure, bottom line, anytime you're buying an older vintage property that's going to need some love, the thing that we mostly focus on when we buy that stuff is you got to have a really good basis, and you got to buy that deal right, because over time, real estate heals all wounds, right? 10 years from now, it's going to probably be worth more, most likely. But if you don't buy that deal right, you're never going to come out on top. You'll just run in place, if not maybe potentially lose money. So anytime you're buying older vintage stuff, you want to understand the heavy lifting, but simultaneously, you got to make sure that you're buying that at a price that you're comfortable with in your basis. And that's the key to buying older assets in areas, where, older assets are, that's what they are. You just want to understand you're buying it at a price you feel good with.
Sure. And I want to follow that up, John, there also by saying that obviously now we are coming up in like markets where, obviously the submarkets or the states that we talk about, right? They're always, sort of hard because everybody's seeing that, yes, jobs are going, population is increasing, there's good amount of organic rent growth and things like that, right? So as people are seeing this, obviously you're seeing assets that are selling for higher and higher prices, right? So all that transforms into that, okay, what's the risk for buying a C-class deal and doing a lot more heavy lift versus doing perhaps, sort of a B-class deal and not doing that much of a heavy lift, right? So sometimes, like let's say if you're doing a C-class deal and you see that, yes, the rent premiums are there, but there's just so much work and some unknowns to be dealt with in that space. Could you maybe talk about some of your mindset around all of this and, sort of how you do that value add as well to get the rent premiums?
Yeah, no, 100%. So the biggest thing that when we look at deals, especially the heavy lifting deals, the two things we look at is the market rent, where the average rent in the building is. And then we also look at the rents in the building. So if you have, let's just use argument's sake, let's say the market rent is $800, your average rent is $650. and you have a couple people in your building paying 700, so you know that, okay, I can get everybody, if they're paying and living in this building, I could probably get them to 700, and the market rent is 800. If you're doing a heavy lift deal, you can't just look at your comps and yourself. You have to look at the nicer, newer product, because if you're going to raise your rents to 800, if their rents are 900, will someone live in your apartment, or will they live in the newer apartment for more money? So we look for a really good spread between Class B and A property compared to where we are as a Class C property. But the biggest thing is that you can't just go into a Class C property, put granite and stainless steel, and think you're going to get $800, because you may, but it's the infrastructure behind the walls. It's all those deferred items that you want to add up. That's the stuff you have to quantify, because if you buy a deal and you make it really pretty and you get high rents, but all your HVACs are shot, you're going to spend $3,000-$4,000 fixing your HVACs, and that's going to crush your cash flow and crush your operations. So when we're doing a big heavy lift value add, the deferred items are the things that you really want to understand, and then quantify that. Then you say, okay, I'm going to spend $5,000 a unit fixing the problems. Well, now what do I have to spend to get a rent increase? And that's the number that you have to calculate to get the return that you want. And then you have to add that to your purchase price, because your purchase price is key. And if you're buying that deal too expensive, you may not get the rent that you need to sustain the business plan. Because if you pay too much for it, your property as a C-class property is going to have a ceiling on rent. You're not going to be able to get the rents to just keep going, because you have A and B class property. So when you're buying a C-class deal, that's what you definitely want to understand is not only the cost for the major heavy lift, but it's also the costs for the unit upgrades. And then simultaneously on the B-class deal, you have to understand, hey, what am I doing here, right? What's the opportunity? And you have to realize that they're totally different deals. You can't assume that you're going to get the same return on a B and an A-class deal that you would get on a well-executed C-class deal. So I just tell people all the time, the biggest key when you're buying the heavier lifting deals is that you really have to understand where you think you're going to take your rents. And if you don't have enough of a lift to take it from 600 to 800, it's probably something that I would shy away from, because you really need a good rent increase for it to make sense. If your cap X is not good, if your major 5 items are not in good shape. And that's the biggest thing to understand, is that, I got to be able to get the lift on rent that makes sense, me putting the money in, that's going to yield me a return.
Sure. And thank you for that clarification, John. And then there are some of those nuances also where, we talk about, let's say, if the building itself doesn't have like a high ceiling that typically we see nowadays, like 9-foot ceilings and things like that. So, you kind of tend to attract a different class of renter as well. Would you agree there?
100%. I mean, those are things, I joke around about it. When we look at a deal and they're comparing the comps to 9-foot Class A comps, and like, yeah, well, I can never be that, because I can't just lift my ceilings up a foot. Like, that's just not possible. So when you are comparing your property, you have to make sure you're comparing it to what your tenants are going to compare it to. Don't compare it to this property. It might be across the street, but if it's a really nice deal, that doesn't mean you can ever be that. You really have to keep an eye on that stuff, and vice versa. Just because the broker or the owner says you could put granite and stainless steel in doesn't mean that you should be putting granite and stainless steel appliances in. It may make sense to keep your black or put white appliances in, because you'll have enough of a delta and a margin where you're still going to attract the right tenants. So understanding who your tenants are and where your tenants work and what your tenants want, that's the key to success in a value add property. Because if you try and attract someone that's never going to live there, your business plan's probably not going to work. And that's where I think people run into some problems on value add, is when they try and reinvent the wheel, and they don't just, they don't understand what they're trying to invent. They just try and, everybody wants a clean, sexy Class A elevator, palm trees when you drive in. Everybody wants those deals, but you can't make a property that if it just physically can't be that. So you have to understand that. And that's how we look at things.
Sure. Thank you. And also, John, speaking of that, give us some examples about, sort of the value add you guys did and sort of that business plan going in, and you did the renovations and things like that, because I always like to, kind of understand for the sake of our viewers, is that how difficult sometimes it is to do a $50 rent bump or $100 rent bump, and the amount of capex or perhaps some of the renovations that one has to do. Could you maybe talk about some of that, or perhaps a couple of examples where you may have been successful?
100%. So, everyone says you can raise rents 150, $200, right? Every single deal you can raise rents. And the truth of it is that you may be able to, you may not. We look to raise rents, but we also look at what is a renovation to get that rent bump. I mean, we talk about it all the time. We have a couple deals where we budgeted like a tier 2 and a tier 1 renovation. One is a nicer, we were going to get a $150 premium, and one was not as nice, we were going to get a $75 premium. But halfway through the business plan, you realize that I don't have to spend my tier 2 money because I'm getting $100 on my tier 1. So then you adjust a little bit. But, the things that we do that are, seem to be, automatic value adds. If you can add washer and dryers, that always works. It seems to be almost unanimously $25 to $50 for adding a washer dryer. But you have to make sure the cost to put a washer and dryer in is what you want it to be. Our rule of thumb is we typically like to get anywhere between a 25 and 30% ROI on our investment. So for argument's sake, we're not putting washer and dryers in if it's going to cost us $10,000 and we're going to get a $50 bump. It just doesn't work for us. So when we look at our renovations we put into a unit and the money we get out of the unit, we're typically looking for, on the low end, 20%, and really good if it's 25 to 30. So if we're going to get a $100 rent bump, that's a $1,200 increase over the year. We don't mind spending $4,000 on that unit. And then we're going to look at our comps, understand what our comps are doing, and say, okay, we're going to do flooring and appliances, or we're going to do countertops and, all new lighting package. But for the most part, we're backing into it based on what we think we can raise rents. And then we're looking at the scope. We bring our contractors out and we bring our managers out. How much is it for flooring? How much is it for appliances and new cabinets and countertops? We get the full package. And then we look and we say, okay, what do these residents really want? They want flooring and they want appliances, and we'll back into what we believe to be the best bang for our buck to get the premium that we want to achieve. We don't just go in with a blanket $10,000 a door, because you may spend too much money and you may not be able to achieve that premium. So you always want to get the cost for everything, and then you want to see what residents want. And you got to be a local expert, and you got to use your experts, and you got to say, okay, what do the tenants want here, right? Oh, they all want, they love carpet. Okay, well then keep the carpet, right? If they say they all want laminate flooring or vinyl, LVP flooring, well, you got to do the stuff that your residents are going to want, so you can get the lift in rent that justify the spend in a C-class deal. In an A and B class deal, you could go in and put Nest thermostats, and you could spend the 10, 15 a door because you're dealing with a different renter. In a C-class property, your renter, they're price conscious. So you put granite in, that's great. But if you can't get a $200 lift, it may or may not make sense. So you really got to understand, you got to get your complete pricing for everything. And then you got to pick the ones that are going to benefit you the most to get the highest premium.
Sure. Thank you for all that detail, John. I appreciate it. Now, talking about on a similar topic, let's talk about sort of, you're looking at the deal, you are looking at some of the comps, perhaps seeing some reports and things like that, right? So you have some of that baseline data, right? But then as you walk the deal, or as you are looking closely into this deal, are you taking sort of feedback from property managers about, what that demographic is looking like? Are you taking budgets from those property managers rather than just your thought process? So give us some idea about what that whole exact process looks like. Like a deal comes to you, you're looking at it, you're taking perhaps your budget, then you're convinced that yes, it's a good purchase. Could you maybe talk about some of that?
100%. So I always tell people all the time, you need a really good management team. If you go into a deal thinking you're going to get a $200 rent increase and you're spending $2,000 a door, whatever it is, if your manager says you got to spend $4,000 a door to get a $100 rent increase, you got to be on the same page. And you definitely need to underwrite a lot of deals in a market, and you definitely have to tour a lot of deals in the market, and you want to see management reports on their other properties, right? Because if you think you're going to run a deal at $3,500 a door and they're running all their deals at $4,500 a door, for argument's sake,
Sure.
Your deal's not going to run at 3,500 a door if they're managing it. So you absolutely, without a doubt, need to look at the deal with your manager, use the reports, use the manager's reports, use their 2 cents, their local experts. So you definitely need to go about the deal. You want to be on the same page. And I tell people all the time now, we own 800 units in Jacksonville. If I get a deal in Jacksonville, I know exactly what my expenses are going to be because I have enough scale in that market where I don't necessarily need my manager's budget. Now, we always go through our budgets with our managers during due diligence before we buy the deal, and we make sure they're rock solid. But if you've bought 10, 20, 30 deals, you know how a property is going to operate.
Sure.
If you're looking at the expenses on a property, you know which ones you should be able to save and which ones you may not be able to save. So I tell people all the time, you got to be on the same page, because if you're not on the same page with your management team, it's going to be combative from day one and you're going to run into problems. But all the reports out there are good and you should use them. But before you buy a deal, make sure you're getting the proof. What are the water bills? What are the G&A? What are these expenses going to be, so that I can understand them and make sure we're looking at this the right way.
Sure. Thank you for that detail, John. Now, as you start to look at these deals and things like that, are there any quick underwriting steps, like what, or perhaps the other way to ask that, John, would be is that a deal comes to you, right? What are the first quick steps you take to kind of understand that, okay, does it make sense or is it too pricey for whatever reason and things like that? Could you maybe share your process?
So we have a 60-second analysis that we do really quickly. Deal gets sent to us. Go to the NOI, and you want to basically see what it is. So you take your average rent, multiply it by how many units, divide it by 2. It'll give you an NOI, and you throw a market cap rate on it. Let's just say 10 cap for easy math, right? If you have $1 million in gross rent, $500,000 in expenses, $500,000 NOI at a 10 cap, it's worth $5 million. That's the high level, right? Call the broker, call the owner. What are you looking for? Oh, we want 9. Probably doesn't work. We're probably not going to get there.
Sure.
If you do that really quickly and then they say they want 6.5, well, okay, you know what? We're close. Let's start digging into this thing to see where it shakes out. That's the back of the envelope. Then now you got to factor in your other income. You got to factor in your vacancy. You got to factor in your reserves, your below the line capital. And then you start digging into it. The other numbers that we use, high level, we look at the expenses, not including taxes and insurance, because taxes and insurance, most likely taxes will go up and your insurance will probably go up if it's been a long-term owner. So you just want to make sure that your expenses are in line, high level with them. Typically, we're seeing operating expenses anywhere between 45 and 55%. That normally comes out to, on a C-class deal that we own, in and around the $3,500 to $5,500 a door. So those are the high level numbers. Obviously, if someone just takes $5,500 a door, it may or may not work. So you really, I would recommend the first one. Take your gross rent, take your expenses, and then divide by a cap rate on the NOI, and that'll get you pretty close. See how far away you are from what their asking price is.
Sure. Thank you. Now, as you are doing the deals, John, like what are some of the challenges that you face on a day-to-day basis as far and wide of a portfolio that you have now?
I would say the biggest challenges right now for us, buying deals that we want to buy. I still think a good deal is a good deal, no doubt. But the market, we don't know what's going to happen, right? We're in uncharted territory. There's 40 million people out of work. Who knows what's going to happen with stimuluses or no stimuluses or government aid. So that is really making it hard for us to underwrite because, there's no rent growth in 2020. There's no rent growth in 2021. You really got to start looking at 2022 and 2023. But if any of us knew what was going to happen in 2022, 2023, we probably wouldn't be talking to each other, right? We would be so much, in a totally different space. That's probably the biggest objection and hurdle for us now. The other thing that we're tweaking on a day in and day in basis is just operationally. What can we do differently? Is there technology we can use to better do asset management? Is there things that we can integrate in our own company to make us more efficient? But those are things that we work on day in and day out. We have a weekly meeting every week We talk about operations and, okay, what could we do different? How could we have done different? We also do a review of old deals. Okay, this deal we bought in 2016, we sold it in 2018. What could we have done differently? And if we know, okay, we could have done this, we could have added washer and dryers, we could have done a pool, whatever it is, we look at old situations. They may have been super successful on paper, but we look at that to say, if this comes up again, what would we have done differently and how we can execute? And that helps us get comfortable with, okay, we could pay for it at this price. So it would have made sense here. So we're just trying to, we're always trying to get better and educate ourselves on what's going on in the markets. And the biggest challenge right now is just, like I said, it's getting the right deal flow and then simultaneously just always tweaking your internal processes to make sure you're really doing everything you can to be the best you can be.
Sure. Now, talking about that deal flow, right? Are you like very proactive in maintaining relations with brokers and things like that to give you the deal, or are you doing any off-market sort of deal marketing and things like that? What does that sort of the equation look like?
So I will be the first one to say we've really sucked at it over the last 6 months because we just haven't been doing as good a job. But we have a system that we use that we try and touch base with our brokers once a month. We are, we used to cold call 350, 400 calls a week to property owners. We used to send a ton of direct mail. We still do, not nearly as much as we should. And it's something that every quarter we evaluate, say, we should have sent out more. But I recommend it, if you're talking to brokers, stay on their radar. It's the squeaky wheel that gets the grease. So you gotta be in front of them. You gotta underwrite deals, and we're doing it. But the deal flow, the reason why we haven't done as good a job in 2020 is, these are statistics, right? The deal velocity of the market, it's down 70%. So there's way less transactions taking place.
Absolutely.
There's still a lot of money chasing deals. So, a broker sends us a deal. They may send it to us because we're going to close. But if the seller wants a ridiculous number, we're probably not going to be competitive on that. But you just want to stay out in front of them and do things different. After you call a broker, send them a $20 Starbucks card. Hey, thanks for the time. Remember his birthday. Send them something every 6 months. There's little things that you can do to stay on top of their radar without just, hey, give me a deal, give me a deal, give me a deal. That's good. But at the same time, a broker is most likely not going to just give you a deal, right? He's going to put it through market. He's going to send it to 4, 5, 6, 10, 20 people. You got to be different, and you got to have a very specific criteria, because then when the broker finds that deal, you'll be at the top of his radar. But yeah, we are not doing as good a job. We are integrating things every day to be better at it, but we definitely could be doing a better job.
Sure. Now, folks at your level who have, a certain scale of portfolio, John, the trend that typically I see is that they'll start from a hardworking C-class place and try to get into that B plus, sort of space, and which means, lesser risk, lesser headaches, and, like more stable returns and things like that. Is that kind of your progression path, you would say? Is that your mindset as well? Or perhaps you say that, hey, it doesn't matter, we will look at every deal on its own merit, and we would not shy away from even purchasing the C-class assets as well. What is sort of your thought process there?
That's a great question. So the transition and the normal progression is yes. And we've done it ourselves. I mean, we are not buying deals today. And this is partially because of the market. And this is before COVID-19. This is prior to that. We made a conscious decision to not buy in tertiary areas. Not that we didn't execute deals well there, but there's a level of getting on a connecting flight, right? We want to be in areas where there's a direct flight. We want to be in areas where there's 1 million people or more. Now, if we found a vacant deal in a market that we're invested in or that we really like, we would jump all over it, and we would gladly do the heavy lifting C-class stuff. Simultaneously, I had this conversation today with my partner. He said, are we buying a deal for the rest of this year? And I said, yeah, I'd love to buy a deal, but it's not going to be a 30 IRR. We're talking about 12, 13, maybe, and 7 or 10 years. So there's something to be said about getting a really steady, high single-digit cash flow, no headaches, good loan going forward. And there's something to be said about, getting dirty, getting your hands dirty, buying some heavy lifting stuff. And we love the heavy lifting stuff. If someone brought me a deal that's super heavy lifting, I would jump all over it. I love those deals. But it's got to be worth the risk. And in today's market, with the unknowns of the unemployment rate, with the unknowns of jobs, and with the unknowns of where people are moving, where people aren't moving, we're probably more inclined to scale back pushing for that stuff. If it comes across our desk, we're going to do a due diligence on it, but we're not going to go seek out those deals unless we're getting them at a ridiculous price discount. More often than not, we're going to hang in there, and we're still doing the heavy lifting deals. But right now, we're probably going to steer towards maybe a C plus B deal, or maybe a B minus B plus deal, just because there's less. I believe there's less risk in that space today. Whereas the C plus stuff, who knows what's going to happen, but we still will do them, but we're just going to be a little bit more cautious going into them.
Sure. Now, as far as deal structuring, John, what is sort of your favorite method or typical sort of a deal structuring? Do you like pref returns, or how's that math play into your deals?
Yeah, so that is our normal deal structure. I would say 9 out of 10 deals, it's an 8% pref, 70-30 to 14, and a 60-40 split over 14, with an acquisition fee up front, and then an asset management fee for the deal. Now, with the uncertainty that's out there and going a little bit more longer term on deals, we have thrown out the idea to our investors of no pref anymore, because if we have to own a deal for 10 years, now we also co-invest in all our deals. So we invest 20 to 30%, if not 50% of the equity. Our equity be treated as LP. It wouldn't be treated as the GP, but we are tossing the idea out to our investors. Hey, we're probably not going to flip this deal in 24 to 60 months. It's probably going to be a 7 or 10 year hold. Let's work a structure that makes more sense, that incentivizes us to hold it for cash flow and not just execute a business plan and get out, because we don't know what the future is going to hold. But all of our deals prior to 2020 really were under that 8 pref, 70-30, 60-40 split, give or take, right? You fluctuate up and down a little bit, but that's typically what we did. We started doing press really early on. I don't not recommend them. Just, make sure you understand your business plan, because there's nothing worse than working for free. And your investors don't want you to work for free either, because you're not going to treat their investment the same. So those are the conversations we have with our investors, is saying, hey, we're in it for the long term. You want us to be in it for the long term.
Sure. And it makes sense. And as you rightfully indicated, I think the state of the market that's there right now, I think, I mean, we see a similar trend where the prefs are starting to sort of get lower and lower. And in some cases, as you rightfully said, that, hey, maybe let's just work out a flat 80-20 split or something along those lines, and see if that makes more sense, right?
100%.
Now, speaking of, let's say investors and capital raising and things like that, right? How has been your experience? Meaning, you started with some, and obviously you have so many deals now. What are some of your lessons learned, perhaps, or maybe you can talk about, kind of share what are some of your best strategies to kind of find newer investors and things like that?
Yeah. So the best thing, the 3 pieces of advice that I tell people all the time: if you're looking to raise money, offer an opportunity, don't ask for money. If you want to raise money, you need really good contacts, and you got to have good relationships. So you got to always be meeting new people, always staying in their mind, sending them a newsletter, giving them an update, let them know what you're doing and why you're an expert. And then the third thing, which is probably the most important thing ever, when you're taking investor dollars, make sure you know who the investor is and if the investment is suitable for them. The last thing you want to do is take $100,000 from a guy that only has $100,000, because if something goes wrong, he's going to need his money back. And those are uncomfortable situations that nobody wants to be in. So you just want to make sure that you're taking an amount of money that someone realizes this is a long-term investment. So really, really, really understand your investors. When I first started, like anyone, you got to beg, borrow, and steal, right? You're asking everybody, give me 5,000, give me 10, give me $1,000, right? You're doing everything you can to get the deal done. But if I could look back and tell myself something about that, I would have probably said, don't, get the right investment from the right person, as opposed to just, taking on 45 investors at $1,000, right? You're going to regret that, 6 months into the deal, when they're calling you every week saying, hey, what's going on? So that's the $1 million question. You just want to make sure you understand who your investors are.
Awesome. Thank you. I appreciate it, John. Now, speaking about a few things about property management and things like that, typically, what is your process? After you acquire the deal, are you typically changing the property management, or you're looking to keep them in place, or maybe keeping like key players and things like that? Or what does that process look like for you?
Yeah, so we use our own management, not in-house. We use third party, but we typically don't retain management. We may retain employees from the prior managers. We just took over a property that we bought not too long ago. We kept the on-site, the property manager. She's phenomenal. She's probably our best manager in Jacksonville. We don't always change the staff. We interview them. We understand who they are, and we see if they fit with our vision going forward. But we bring, we have two management companies that we really work with, the two big ones that manage most of our properties, one up in the Midwest, one down in the Southeast. And we look to scale with them and their team. So it's the same management company. The on-sites, the maintenance guys, they may change, they may stay, they may go, but we're bringing in our own team and how we do things, our own management software, all that stuff.
I see. Awesome. Thank you. A couple of last questions there, John. Now, as you have networked and you have transitioned in your career, what is some of your great advice that you kind of have gotten or you remember on an everyday basis that kind of keeps you in discipline, as you conduct your activities daily?
I'll give two. One is can't be scared. You gotta do it, right? It's easy to sit back and underwrite deals on your computer and never do anything, and then look back and say, "Shit, I should have done something." You can't be afraid to get knocked down. There's a level of fear, and there's a level of risk, and there's a level of trust you're gonna have to give to somebody else. But you're gonna get knocked down, and you got to get back up. But you can't be scared to get started. That's the one biggest thing. The second thing I tell people all the time is that a good real estate investor is not somebody that never loses money, or a good real estate investor has a really good database and network where if a property gets a little bit off track, no property goes A to Z directly up, right?
Sure.
A good investor is someone that when a property gets a little off track, they can get it back on track quicker. Those are the deals that succeed the best. So you got to have a really good network. You got to get out there. You got to put yourself out there. You can't be afraid. You got to get out, get on podcasts, listen to podcasts, get out at networking events. I know with Corona, it's a little tough now, but you can't be scared. You gotta give it a shot. And you got to be out there. That's the best thing that you could possibly do.
Awesome. Incredible advice, John. Thank you for your time and your expertise and sharing all your experience. Share with our listeners how they can find you and learn more about your company. And
best way to find me, my email address is John, JOHN @Toro, TOROREP.com. You send me an email there. I'm typically pretty responsive, get back to you within 24, 48 hours. You can also follow me on Instagram at John_JC, or reach out to me on Facebook. I'm not the best at social media, but I'm trying to get better because it's a necessary evil. But those are the three best places to reach out to me. I recommend anyone, if you have a question, you want another set of eyes, real estate is a business about networks. So don't be scared. Reach out, pick up the phone. Within 24 hours, if you give me enough time, I will make sure I give everybody 20, 30 minutes to hear out a concept, an idea, or a thought, if anyone has any questions. But email, Facebook, or Instagram, best places to reach me.
Awesome. Incredible. Thank you for coming on. For viewers and listeners, they can log on to premiumcashflow.com and see the news articles and, of course, the podcast as well, where experts like John are always present, sharing their advice and all the different incredible experiences that they have had. And if you're interested into any passive investments, kindly register yourself and reach out. We can have a short phone conversation and understand that what you're looking to do and if there's any alignment, and we could help each other. So it's been a pleasure. Thank you to all our viewers and listeners. And thank you, John. I greatly appreciate, and I'm positive that we will be talking on another future episode with a lot more, sharing your experiences and tidbits of the things. Thank you for coming on.
Absolutely. No, I appreciate it. And we're definitely going to have to get you on our podcast too, for sure. But no, it was a pleasure. I hope all the listeners and viewers get some good value.
I appreciate it. Thank you.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.